Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment markets so you can understand what we see in the global landscape and also how we're currently positioned. You know, we've been getting a lot of phone calls and emails and questions, not only on our TV but radio show, about our strategy. And our clients understand what we do and how we manage money effectively and actively. One of the things I try to teach all investors is passive investing, buying, holding through major market corrections is a thing of the past. I think too many investors saw too many big losses in 2000 and 2008, and that's effectively why Resney Wealth Management runs a strict relative strength investment strategy. We're not buy and hold investors. We don't set it and forget it. We actively rotate our portfolios through all asset classes. So basically the way to explain what we do and how we do our strategy is, if you think about a horse race, you have 25, 50, 100 horses in your stable. We look at all of those horses, which are investment sectors, and rank those on a proprietary relative strength system. Relative strength is how are those assets performing and how are they rising versus falling against other competing asset categories. Sometimes that means we hold cash, sometimes we hold treasuries, or we hold gold, or maybe we're in more small and mid cap in the US like we are right now. Now, while all investment sectors, generally speaking, don't perform the same, again, a rising tide lifts all boats, but we want to be in those stronger boats that are going up much faster. And again, sometimes that means being conservative, like in market corrections in 2008. We're going to have another one of those in the future. So effectively what you want to do is rotate out of weaker sectors and into stronger sectors. While we're hearing on the news about all these new highs in the market, it's not all markets that are hitting new highs. In fact, if you look at a lot of the emerging market large cap, a lot of these actually are doing very substandard this year. Now, we're not in large cap emerging markets right now because they've been relatively weak. Small and mid cap in the US actually has done quite well, and so has small cap emerging market. We continue to own positions in mortgage-backed REITs because those are relatively strong on the income side. We continue to own emerging market bonds because, again, they are coming back and they're getting relatively strong also. So at the end of the day, relative strength is a great way to look at how investment sectors are performing, and you want to own those relatively stronger sectors until they're no longer relatively stronger against other assets or other sectors that are competing against them. So again, I always try to explain, you don't care if you own horseshoes or hand grenades in your portfolio as long as it makes your return on your money given your risk profile. I know that's a simplistic way to look at it, but too many investors, especially people that come in and hire my firm, usually are one-dimensional. They're usually in bonds or equities, and usually equities or bonds in the US. In fact, we had a newer client that hired us, and they were using a big money management firm, and all the money management firm did is buy large cap US equities. They would buy and hold those up and down through all market cycles. So the problem is you only own one asset class. It's great when that asset class is strong, but what do you do when it's prolonged and it goes down for 12 or 15 months? That's exactly why you need an investment strategy that's not only objective, but adaptive to changing market conditions. You need to freely rotate your portfolio out of weak asset categories. Sometimes that's the stock market, sometimes that's the bond market, sometimes that's real estate, and rotate into stronger investment sectors. That's a way, in my opinion, to gain growth in your portfolio and have a decisive way to manage risk in severe down markets. You're always going to have these little bumps up and down, but at the end of the day, the old-fashioned buy and hold, set it and forget it asset allocation strategy where you ride the markets down 30, 40, 50%, we firmly believe you don't need to do that anymore. And if you use a decisive risk management strategy and use a relative-based strategy and you rank your categories or your sectors on an ongoing basis and freely rotate around those stronger sectors, sometimes that means you're holding a lot of cash to protect your portfolio. Again, the economy is getting better overall. We like what we see. We're currently fully invested. If you're a client and you have a question about your portfolio, please give us a call. If you're not a client and want to become a client and you want to benefit from our investment management, our active non-set it and forget it strategy, active management is where it's at. Relative stronger sectors outperform, relative weaker sectors underperform. Call our office for a consultation. We always like taking on new clients who are nice people to do business with. Have yourself a safe and profitable week.